Greetings, everybody. This is Jeff Scott. Welcome to this week's review. I titled today Waiting on the Bounce. We certainly had a hard sell-off in bonds, followed by stocks and pretty much everything else you probably own. And let's take a look at where we're going to go this week. I'll be announcing at the end of the front section a live webinar, which I'm going to do on Thursday evening this week at 8 p.m. Eastern Standard Time. I'll also put up an invite for that in the Discord site. If you don't participate on the board or the Discord site, then email me, but please keep the emails only if you don't have access to the other sites. Email is hgsidoc@gmail.com. As always, it's for education purposes only. I'm a doctor, not a broker. I have nothing to sell you except invite you occasionally to a live meeting, which costs me more than it costs you because I lose money every time intentionally. I am on my live meetings, not on my trading. I am a doctor, not a broker. Most physicians lose money on their investments, so keep that in mind. I try and change that trend. Try to help a lot of my friends not to lose money either. I'm independent. I can talk about whatever I want to talk about. I do own and have paid for everything I use. No one pays me to say good things about them. Trading involves risk. You and your owner are solely responsible for any of your trading, all of your trading. I always entitle my education, Be Your Own Guru. I learned from some very smart people. I started by reading O'Neill. I got exposed to Morales and Catcher through Ian Woodward, who took O'Neill stuff and made it to be more appropriate for today and put it on the computer. Ron Brown is his partner. George Lee, a great trader from Western Canada. If you see an invite to one of his meetings this weekend, an online meeting, I highly recommend it. He's just a great trader. Dan Tharp, I read his books. They're big, they're deep, but they really talk about how to manage your money. Cigar down here from Superior Profit has some indicators I use in TradeStation and Metastock. I wish he had them in HGSI, but HGSI is a closed scenario. And it's just been I found it very useful add-ons to my trading. And then the guy that really changed my trajectory, Dan Person, funny things, I bought his indicators long before I met him. And then, like everything else, they sit on my computer and I wonder what to do with them. Then I went to one of his seminars, got to be friendly with him, moved to Florida, and now we're buddies. And great author, great tools. Taught me how to golf too, which ain't so bad. That's one plug there. But the funny thing is I did buy his stuff before we even got to that point in our relationship. So when I do education, my goal is to take what I've learned from these and others and then help you become a better trader. I have lots of different programs. I need TradeStation, Thinkorswim, and not probably every indicator I've bought, but certainly a lot of the ones I use. And then I like an offline analytic program. And the reason why I like it offline, why do I need HGSI when I can do scans and TradeStation or Thinkorswim? It's actually a pretty simple reason. I found that those tools are not as fast as the things that I have are on my hard disk. EdgeRater has automated things. Yes, I like seasonality and a number of websites. Speaking of websites, here is the highgrowstock.com website. The key thing here is it's a free 30-day trial, no credit card required. And under investing strategies, you'll see hundreds of videos from myself, Ron Brown, and others. And really designed both about how we trade, but also how to use the program. And don't worry about the name. First, I'm independent, so my email address is closed because I've done a lot of free, unpaid volunteer support over the years. But the other thing is it's a horrible name for some product that is actually just a great foundation, whether you're value or growth, whether you're long-term or short-term. The only downside is it doesn't go below daily, but for a swing trader like me, it's perfect. Stock patterns are cyclical. Now, in reality, what I should have done is taken this and just rotated it like this, because this is what the market's been doing this year. And every time it looks like it's about to break out, it pulls back. But it doesn't come back to the zero line, and then it does another move up. So you want to find the points where you're pulling back to support and moving up. You want to get short the market when it's about to roll over. Now, the challenge we've had is it's been a very short move where you get a move up into resistance and then you pull back. And just when you think you're breaking down like we are right now, you get a bounce. So we'll see if we get the bounce this time. But this has been a very difficult market to change. Therefore, you should be living in uncertainty, which means you should have been prepared with cash, smaller positions, perhaps selling some premium. And I've been banging the drum on interest-sensitive stocks and with higher rates to look at. Banks haven't worked out well. They've been flat, but insurance companies have been one of the places that I've made some money in, despite the market pulling back. I'm a decent trader, but this has been a tough market for me too. I won't say that I'm making money the last week. 2 weeks ago I made money. This past week was a little rough, but I'm still up a lot on the year. I don't even need to put well. Friday sector review, just looking at where the movement was. The green was clearly in utilities, almost over 90% were positive. Looking like consumer staples. So these are defensive plays, and that's not a big shocker. Energy mix and everything else have been mostly down. Look at how weak the technology sector is with just a few islands of green. Dow Industrials, few islands of green. Financials, despite rising rates, few islands of green. Materials weak. So the strength, staples, and utilities. Now let's just look at the major markets. It's funny, markets have turned down twice when I bought a boat. I bought a boat this year in January, right at the end, and I cashed in a lot of my positions. And the funny thing was, if you go back, let's get a full year's worth here. I bought my boat on the 25th. This 26th was the high of the market, and then the market sold off. And we've been heading up, and here's what I mean by you run up, down, support and downs, resistance to support. And then we've had these very narrow oscillations. So if I base that on all that, this being the E-minis, pull back and touch the 50-day moving average, it's at a place where I'd expect it to bounce, unless it's different this time, right? Do we continue in these shallow pullbacks of which we would expect to bounce? Or are we going to go all the way down to the 200, which is another 115 handles? That's a big move. Now, the NASDAQ looks worse. Let's put the NASDAQ on an annual. Before I go on, let me show you the S&P high occurred September 21st. So we're just off the highs, but it's been a pretty rough couple of days. Now, the NASDAQ, let's give it a year. You can see the highs of the year occurred even more recently, back on October 1st, but it's knifed hard. It did not stop at the 50, and notice going back for quite some time, since May, the 50 has been support. Now, if you go back to the pullback after the January highs, the 200-day or the March highs in April was support. So again, Ian always taught us a high, middle, and a low road scenario. I think the middle scenario is it pulls back to the 200. The high road is it moves up here, and the low road is it breaks down further. The middle road scenario from 74.38 to 70.38 is 400. That's another 5.5%, 6% move. If you're heavy into growth stocks, that could be another 15% hit to your portfolio. I'm hoping for the high scenario, but we'll see how close we get to that 200. You look at the Dow. Now, the Dow is kind of a little bit healthier looking. The funny Dow, it said its first peak early in the year, and then just got above the annual highs and had a peak a couple trading days of 26,966 on the 3rd. Now the Dow stopped and recovered at the 17-day moving average. The Dow is the strongest right now in that same pattern of shallow pullbacks. The dollar is at a point, the Dow also is a point where if this is the end of the pullback, I might expect it to start moving up. That recent sell signal is a little bit bothersome. Now, if I look at the Russell had been and is the weakest. And notice where the white Russell went down and tagged. It tagged its 200-day moving average. Now, if I'm a betting person, it tagged it. It may test it again a couple of times as it's done in the past. but maybe the Russell's the closest to be going down. But the Russell's in a clear down from 173 to 160, over 10%, or about a 10%, almost a 10% pullback. The VIX, interestingly, despite the big moves, yes, the VIX had a big move up this week, but the VIX closed where it struggled at for some time, which is its 200-day moving average. So you have a topping tail here. It'll be interesting to see if the VIX can break above this, or is the VIX going to come down? And then the dollar actually sold off Thursday and Friday, and the dollar is almost looks like a head and shoulders setting up. But the dollar, if we'll look at it on a weekly in a few minutes, has been in a downtrend on a longer period of time. So that's the dailies. If I quickly swap to my weeklies, and just to point out that all of the major indices are in nice long-term uptrends. In fact, the E-minis and the NASDAQ are in weekly buys. The Dow's in a weekly buy. The hardest bit, pulling down to the weekly 50, which is about, getting close to the 200-day moving average, is the Russell. Notice the sideways movement in the VIX, and that the dollar here is struggling to get above that rising 200-day moving average. And on my daily weekly charts, this is just columns of E-minis, NASDAQs, Russells, NYSE, and the Dow, daily, weekly, and monthly. And I always put this up to remind me that we're in long-term uptrends, but the short term looks really ugly. And we've got a lot of sell signals on the dailies. Will Monday be one of those big down days that leads to a reversal? That wouldn't shock me. Probably take something coming out of China. Maybe we got the big reversal on Friday and we're going to bounce on Monday. I do think we're close to a bounce. I'll show you more evidence of that as we go forward. Now, those who watch me, I have had these lines written on my 10 on the left and 30-year Treasury yields for years. And I always talked about these being sort of getting above this line here on the short term was always when the market seemed to perform better, and that if I got above this line here is when I was concerned that the markets would fall back. Now, interestingly, on both the 10 and the 30 years, we spiked above those key rates, and the market started selling off. So we're at a place where rates are starting to rattle. I still think that long term, banks, especially regionals and insurers, will actually respond well to it. I think the Kavanaugh and some of the trade wars are causing some of the defensive names to do better than the ones that should benefit from the rising rates. Now, interestingly, in blue is the spread, and the spread actually picked up some this past week. So as I look at the spread, I have to wonder, are we going to come all the way down or not? And I've talked before that the spread here, it's not all showing, I don't think. Yeah, for whatever reason, the S&P 500 is not showing on this. Let me see if I can get you into my, all right, so I must have opened up and took a picture of the wrong one. My apologies. There we go, that's the one. What I like to point out is that typically the S&P doesn't fall until we start to turn up on the falling. This is the yield curve, the spread between the 2s and the 10s. The dark pink here is when it flattens, it hits this. This is the flat line. When it overshoots, it gets below. And the blue is the S&P 500. And the S&P 500 turns down every time this starts to turn up. So it hasn't gotten to flatline. I don't know if that means anything, but I continue to watch it. But all the people that are talking about the flattening had to back off a little bit this week. It's a little bit less flat than it was. AD lines is with the market weakness stove, both small and large. In fact, you can look at the AD line at NYSE, which is this dark white line, And then a bunch of ETFs here, the diamonds, the Qs, the spiders, the Russell and transport stove, Russell diving the most. And look what's happened to TLT with bonds. Now, the number of stocks above the 200 and above the 40-day SMA have also fallen. And what's most interesting is my 3-week new high, new low ratio is getting down to bounce range. You only had 8.42% new 3-month highs versus new lows. And that's a very low number, the ratio of the two. During a period of time of a market that's oversold, you have 98% of the new high, new lows are new highs. So here it's only 8% of the total. We've been lower before. This is about a 1-day move. So we're probably close to a bounce. And we always bounce when we tag, get close to that 0 to 2 range. The daily McClellan has broken down. We've seen divergences there. We're not at levels of such sold levels that they would predict a bounce based upon the oscillator or the summation index. All right. Current buckets. 77% of the S&P 1500, I'm going to update my stocks today, but those were chosen in July, were below the midline of their Bollinger Bands. That's clearly bearish. Notice that 21% or so of the stocks in the S&P 1500 are trading below their lower Bollinger Band. I expect within a day or two for us to see that number spike above 30 or 35, and that's when we'll see a reversal. So I'll be watching that, obviously calculated in EdgeRater. Hindi signals abate. We had plenty of them, but you're not going to see them now because you have no new highs. So the lack of new highs will make no Hindis, but still a market that's challenged. Market tone, which is the Woody indicator here, has gone very bearish across the board. When I look at sectors, the only sectors that are green are utilities and I believe this is energy. The rest are either neutral or several are bearish. So markets are weaker, sectors are weaker. You know that your portfolio is probably weaker. Canaries in the coal mines, some of the giant stocks, knifing its way towards the 200. Maybe we see a bounce here. We're not that far away. We're about 3 points away, and so about 2 to 3%. What's more apropos to me is the summer solstice index, which broke up here as a wide, doji on Friday, getting close to the 50. That would have been my natural bounce point. This could be a reversal signal, so we'll see if we open up and we're going to bounce. Bounce here would probably make, well, not probably, it would certainly make me feel a little bit more optimistic about the rest of the market. No new news in earnings. I'd say it's a light week on news, although we do have the PPI, the CPI, and jobless claims and petroleum numbers. Looking for Fed speaks, we got Bostic on Friday, Evans on Friday, Bostic also on Wednesday, Evans also on Wednesday, Evans on Tuesday, Williams on Tuesday a couple of times. See, sometimes you get some interesting from them. Then if you look over here, you have Delta. You have Citibank, Wells Fargo, so the financials, JP Morgan. Talk about that in a second, but mostly a light week on earnings. Friday is going to be important because I have to believe that if we see great earnings from the banks, add that to the high interest rates, you might see financials come back into fuego. Market thoughts. I'm going to start on the right. I took my trading universe. And for my trading universe, I only care about stocks that are $5, $250,000, and to avoid contaminating them with things that go up when the market goes down, like Contras. I didn't want any ETFs. Then I ran the buckets and looking at how far away we are from a 52-week high, just to get a sense of how much the markets have pulled back. 40% of the stocks in my trading universe are more than 20% below their 52-week high. If I add the next 5%, actually the next 10%, 28, 69% of stocks are more than 10% down. That means odds are most of the stocks in your portfolio are down more than 10%. The number of stocks within it 1% of a new high or 5% of a new high is about 12%, 13%. So this is a market that's already pretty beat up. As I mentioned before, it was a bad market as bonds dive, markets followed, and the rates break out to multi-year highs. Economic numbers were mixed, but unemployment rate breaks recent lows, spurring some concerns. News flow, I think it improved. Kavanaugh got approved this weekend. Canada joined the new NAFTA, progress on trade with EU and Japan. Quiet on the China front, but then on Friday we heard concerns about Apple. I feel like we're near a bounce. Bounce can just be a short-term bounce. But October is a mid-election year, can continue rough. And be careful, as I said, over 40% of my trading universe, these are stocks that I typically scan and look at, are down 20% or more. I am announcing again, I will have a live webinar Thursday at 8 p.m. Registration material will be posted on the HGSI website this evening and on the Discord site. The agenda will be to discuss current markets and to kind of review my upcoming Florida meeting. Top review to follow now. And just to hold on a second, I should probably comment on that. I just wanted to make a few comments about my upcoming meeting. I've had, well, more than half full. Every day I get a couple more. I'd like to shoot for 20 people. Last year we had quite a few more. It's November 28th. It's $500. We'll do pre and post webinar, post meeting seminars online. We'll have the usual basics, top-down approach, finding my A-trade, how I manage money, options, EPS time, I call EPS roulette, and putting it all together. I've had lots of positive reviews and people made money after last year's meeting. I go over the top and how I'll treat you. You'll get dinner on me Tuesday, most likely on anchor management, my yacht. Potentially we'll go to dinner at a steakhouse if the weather looks questionable. I'll feed you breakfast, lunch, and snacks during the meeting. You'll get screencasts, and I share my indicators that are non-proprietary. If you're interested, email to hgsi.gmail.com letting me know. PayPal to mdonk@Mindspring. If you attend John Person's meeting, which I'll talk about some on Thursday, I'll give you back $100, and then I am open to playing golf on the day before. I do not intend to broadcast, but for those that would like to purchase the materials, although they do not attend the live meeting, I have taken a few sign up for that, and I'll continue to do that. You'll get your money's worth, you just won't gain the weight. So on that note, let's take a look at the markets. It is, as you can see, 1:29 p.m. on Sunday the 7th, so there's nothing that's open right now. This may not be, well, like I always say that and then I lie, so I'm just going to not say it. But I was going to say it may not be a very long meeting. If I go into TradeStation to start, let's just go into market force and divergence. Add one here before I get too long. Data. All right. I want blue. All right. So let's start with the E-minis. I look at 6 typical things. Number 1, are we in a person buy or sell? These are the arrows. We're at a person sell signal. Number 2, is the paint bar red, green, or blue? If I'm looking for something that's going to turn, when I start to see the bars turning blue, it usually signals that we might have a reversal soon, and it signals some MACD divergence. It's a Alexander Elder impulse indicator. Number 3, do I have these red dots? Those show me divergence and suggest a pullback is coming, but we can go a long time before that happens. Notice we have the dots still on the weekly, and the weekly paint bars are still blue. The weekly and the monthly are interestingly still in a buy, so it's a pullback and an uptrend. Number 4, where are we within the bands here? And we've pulled to the lower part of the bands. Typically, we don't live below those bands very often. These are the auto envelope. Number 5, where is my high jump bar at 43%? There's no signal there. And is my weekly bongo still green? It is. So I look at this, I see a pullback and an uptrend. I'm hoping to see a bounce soon. That's all I can say. That's the E-minis. The NASDAQ futures, worrisome in that we've got a red bar on the weekly and a new sell signal. We're in a daily sell signal. That said, we pulled back to the lower level as well. The weekly bongo did flip. This looks a little weaker, but it looks more like a place where it's getting more likely to start thinking about a bounce, but it doesn't have to be tomorrow. The Dow futures, a new sell signal there. The red dots on the weekly, red dots were on the daily. Weekly bongo still green. And then the Russell futures, the worst of the bunch. I've got a big TZA position, and when I see so far below the envelope, I think it's time to start perhaps easing up on that. That said, we have weekly and monthly sell signals for the first time in a while. Gosh, going back to 16, 15 on the monthly sell signals. So this might be something that runs back up into its moving averages and breaks down again. So I'll be watching that. Ignore all the green here. The markets are not open yet. And then if I look at the mid caps, they look a lot like the Russell. So markets are weak, small stocks worse, NASDAQ's then, and then the strongest being the Dow. And it too has a recent sell signal. Now, if I look at the dollar here, dollar has been in a buy signal, new weekly and monthly buy signal. So, the Dow's in a longer term downtrend, as you can see on the monthly. On the weekly, it's in an uptrend. It looks to me like it wants to go higher, which would be potentially concerning. I'm going to handle today a little bit different. Let me take this list of sectors, copy it, go down here, go into user groups, go into this week, make a new group. I'm going to call it Trade Station Sectors. Where is that? Perfect. Let's paste that list. So rather than go through the typical top-down, we start the typical top-down, and then I'm going to just look at some of these sectors and see if we can't identify any strength or find out where the weakness is. So my typical top-down review, I start with Major Markets Plus, and I want to get a sense of what's working now, what's not working now. Again, it's just another way of reviewing strength and weakness in the market. I use my top-down view, and what I see, and it's never good when utilities and Treasury, short-term Treasury Pro shares are leading. Never a good thing. Then gold, silver volatility, and oil and dollar and commodities. That should tell you right now that being in equities right now is not rewarding. May bounce, and it will bounce eventually, but let's just take a look in HGSI, and I'll comment a little bit. So this is the Dow, the S&P futures. I've talked about how it's been oscillating in a channel. It's at the 50, and frankly, let's clean this up a little bit. So whether I look at the 50 or I look at this trend line, it's very close to where I expect it to bounce. So my guess is that we are going to probably bounce in the next 1 to 3 days. And then the question will be is whether we get a good bounce or do we just go up for a couple of days and come back. And I do think that 200-day down here is still a concern. So I mentioned before, I like to always have a high, low, and a medium road. So my high road here is that we're done going down. We bounced off the 50 and the market goes up. That's my high road. My medium road is that we pull back to that 200, to the trend line, and then we bounce. And my low road is we bounce all the way down to the 200 before we bounce and potentially break through. So I'm going to be looking for each of those and then basing my trading on what we see. But I see a market that I think it's ready to bounce or getting ready to bounce, but this is a market that's weak right now. The Dow, no one says it has to bounce. It's not calling me for advice. The Dow's the strongest just off its highs, sitting on its 17s by itself. I'm not too concerned. The NASDAQ, worst performer, knifing down below the 50. And again, is this going to run down here? Is it going to run up to the 50 and fail and then run here? Or is it going to break through? And those are the scenarios that I'm going to be looking for. The Russell, when using the IWM, has broken down all the way to the 200. This is a place where you might expect it to bounce, but it may bounce around for a few days. And we saw back here in August of 2017, it actually broke below the 200 for a couple of days. So markets are clearly weak. If we look at the dollar, not a bad place to be in. But remember on the weekly that the dollar is, this is the cash market. The futures were below the 200. Perhaps it's going to break out here with this 200 acting as support. It's one of those unusual scenarios where the futures and the cash market look a little bit different. The VIX talked about how it tried breaking out last week and it came back down into its congestion. Got to keep a close eye on that. Notice the weekly bond yield just went green. And sort of as a defensive play, we saw a little bit of a bump in gold. But is this just a pull into the moving averages and then drop down? Or is this going to be a breakout? It's going to take a lot to convince me on gold or silver. And silver both running into the down-sloping 50-day moving average. We'll have to see where they go. I typically look at the sectors and we'll do the industry groups real quickly. So let's do that. And you notice whenever I hit warehouse view on my designer, we'll open up the same view here. Got 174. If we look at the ones that are 2-day up, this is it, folks. Utilities, no surprise. MLPs, they pay a big dividend. Healthcare, that's another defensive. Restaurants are defensive. So that's the only groups that have force to the upside. Now, interestingly, force to the downside short term, banks and insurers just turned down end of week. If I look at 5-day downside, I've got 82 groups. And 5-day upside, I've got only 7 groups. So this is a market that's decidedly pointing to the downside. What I wanted to do different today is I don't want to identify great looking stocks and tell you to buy them because A, there aren't very many, and B, I'm not sure this is the right time to be going out and buying lots of stocks. So let's take a look at what I just set up here, which was the sectors. So these are some of the major market sectors. Let's go through 25. How many are there? 28 sectors and talk about it. So we're going to start with the utility sector. These are all ETFs, I believe, unless I haven't looked at all of them to say, but they're probably all tradable. So we look at the XLU. It's been in a nice uptrend since February with the market, pulled back to its 200 and bounced, breaking above the 50. You've got a mobile breakout. You've got a pocket pivot. Everything is green here. The utilities look poised to go higher, which is negative for the market. Financials struggling on their moving averages, but you got the moving averages coming together, building up some energy, some volume starting to come in. My guess is with the rising rates, these things break to the upside, but we'll wait and see what happens there. Gold, we already looked at it, is weak. Regional banks, I would expect these guys to move up in the setting of tightening, rising rates, but they're struggling with the market struggling. Energy sector, price of oil has been good, although it's probably closer to the high of the range than the low. Nicer to buy things off of support. Insurance ETF, this is one that's benefited from the rising rates. It's pulled back to the 50 with the market pullback, still looks good. Natural gas, you can see with the 200-day moving average coming down like that, it's been a long-term downtrend, which is broke above it. Actually looks impressive, although the last couple of days were bad. I'd love to see gold look like this because then I'd be buying gold. Oil exploration stocks, high prices of energy. I think the Halliburtons and the Schlumbergers of the world have taken longer to recover than the price of oil, and they look like they're doing well, although pull back Thursday and Friday. Gold buyers look like gold. Transports have been leading the market higher, and frankly, they confirmed the Dow and gave us a Dow theory signal. Have pulled back since and broke below the 50, so they show some weakness. U.S. oil off its highs, but doing well. Home builders, weak, horribly weak. This is a bingo, which is a baby out with the bathwater signal on the group. S&P industrials look okay. Construction down. Materials down. Staples should look strong. They pull back to support. This is a group that would probably lead if this market with utilities, if this market continues to go lower. Healthcare sector has been strong, biotech aside. And I saw a lot of things with distributors and some of the less sexy plays not seem to be moving. Biotech, as I mentioned, had been very strong. It's pulled back below its 50s. Perhaps it might be a bounce coming. Retail has pulled back down to the 200. This is a place that I might hope to see a bounce. Industrial, spider, nice uptrend, resistance, support. Probably the best behaving that we've seen thus far. And I mean, I skipped that blip. We are living in a channel and we're at the lower part of the channel. And with that blip, yeah. Whoops, sorry, went wrong way. Discretionary actually fell down a little bit. Amazon has not helped. Semiconductors have broken down. Information is breaking down below the 50. Bonds have got hammered. Russell would pull back to the 200. S&P just stuck back on the 50. NASDAQ Qs are breaking down. Now, just a couple things. If you want to play the markets to the downside, these are some of the instruments that I play. I'm long TZA. It goes up when the small stocks go down. TZA looks like it's broken out. Been weak, but it started moving. Now, this is going to be resistance, and this may be when the market turns around. If you think the NASDAQ is going down, you might look at QID, which are ultra shorts on the NASDAQ. Notice pocket pivots, kahunas, mobile breakout from a squeeze. Does it look like a place that you really want to be buying? No, you're buying these as defense, and they've moved off the lows. If you think the Dow is going to be the place you want to go, you could look at the dog, DOG. No, that's not the right one, is it? These are Dow shorts. They've not moved much. If you believe semiconductors are going to go down, you go short semiconductors, SOXL. This is a 3X of semiconductors. If you believe the markets are going to have more volatility, you can go short the SVXY. This used to work for me. It had a lot of net reverse splits. That's why it looks like this. Forget, I'm not going to spend any time. So there are instruments out there that you can buy if you think a certain segment of the market's going down, and they will go up. Now, let me just say that these things are not trading, they're not investments, they're trading vehicles. You're buying them for short periods of time to capture a big run when there's market volatility. If you go back to 2007, for those that were actually around then, most of these were not, they were sky high. Now, the reason why this thing is at 12-ish and back in 2010 it was at 4,000-ish is because there have been a bunch of negative reverse splits. So be very careful on these. Over time, they all go down, but during short periods of time of market aberration, they're great ways to play a move to the downside. Now, for a few seconds, I'll put up the stocks that I was looking at and interested in. There weren't many, and my level of interest in buying individual stocks right now is weak. Right off at the top here, you see the QID, you see TZA. So I'm thinking of shorts as well. Let's take a look at industry groups. You can see utilities were strong. And other than that, oil, gas, services look strong. Other than that, it's just one-offs. So, I think my message here is be very careful. As I look at this, some of the ones that I thought had the nicest looking charts, REGI, renewable energy, barely makes on some days my volume number. But this is one that has been leading and I think going sideways right now. Squeezing with multiple breakouts. This is the kind of stock I like to buy when it gets some kahunas and it takes off. So this was one that looked good to me. REGI. BioMarin looks like it's getting ready to go higher here. If healthcare is strong, you've got a kahuna, multiple breakout and a squeeze off the 50. I like that. Just because they're here doesn't mean they're great buys right now. Wingstop, a nice high base here. 2 kahunas out of 3 days, a mobile breakout from a squeeze. Those are some of my favorites. I'll leave the list on. We'll review how they did on Thursday. I'll also on Thursday review the bucket. So on that note, I'm going to say goodbye. Thank you all. I know it's a short one this week, but there's really not a lot to go out there and tell you to buy. Have a great week. Be careful out there. I do expect a bounce. I don't know if that bounce is going to go to new highs or just be a better shorting opportunity, which is potentially more likely. Be careful, trade safe, and I think right now trade small. Goodbye, everybody.